Hi, welcome to Let's Talk Bonds, the bond market podcast from INR Bonds. I am Arjun Parthasarathy. And the biggest issue facing the market, or the biggest issue that is on everyone's mind, all market participants, this is across all markets, currencies, equities, and bonds, is the fact that the rupee has been steadily depreciating. It's fallen by 4% against the US dollars and is trading at record lows. And this has suddenly happened, and a lot of other surrounding things have happened along with the rupee depreciation. There are various factors to this, various causes, and then now the market is talking about rupee trading over 90 to the dollar and many other issues. But the question mark is, what do investors need to worry about this rupee depreciation? How much do they need to worry? Especially investors in bonds and fixed income markets, how much do they need to factor in the rupee depreciations in their investment thesis? And uh, the rupee, if you look, the RBI in its recent monetary policy has mentioned that the rupee has depreciated and it's trading at record lows, and they've given the various factors for that. But they've not really come out and said that there is any cause for concern. The macros are looking stable, etc. Now, is the market should take comfort from that, or the market continues to remain in a worrying mode, and all those issues. So, in this Let's Talk Bond podcast, we will talk about the rupee and its effect on bonds. Should investors worry about the rupee depreciation on their bond investments? Before we start, just to remind investors or listeners here that bond markets carry interest rate risk, prices can go up and down, and credit risk that issuers can default, and liquidity risk where the impact cost of selling or buying can be pretty high in the market. So investors have to look at these three factors, risk factors, before investing in bonds. Now coming back to the topic today on Let's Talk Bonds, the rupee has fallen and fallen suddenly. So for a long while, it was holding at around rupees 83 to the US dollar. And in the last few months, suddenly from 83, it's fallen to closer to 88 to the dollar. That is almost by 4%. Now that's a sudden, very sharp fall in the rupee value against the US dollar. And if accompanying it, initially when the rupee started to fall, the RBI had to step in and sell US dollars to stem the fall of the currency. That is not to have a target value. RBI has stated that they never have a target value, but to manage the fall so that it doesn't cause too much of disruption in the market. But because of this, they had spent about almost 60 to 70 billion US dollars to by selling the dollars. And over and above this, have also sold dollars in the forward markets. And that's also a very large position, closer to $50 billion. And put together about 100 plus billion dollars they have spent on trying to stabilize the rupee. And clearly it has not worked. And they knew that it would not work because no, when the currency starts to fall, over the ages, it's been proved that no central bank can step in and continuously sell continuously sell the currencies to protect their own currency, and by doing so, they'll only um, decrease their foreign exchange holdings, and that will add to more worries on the external and the macroeconomic conditions of that country. So, I mean, I will not go too much into the reasons of the fall. I think, everywhere there have been a lot of market news, and all the experts have been talking about the Trump tariffs and the effect on global markets, effect on trade, and effect on capital flows. We have seen FIs taking money out of the country, etc., to put it back into the US markets, and all that story surrounding the rupee fall. But the question is, let's go into a deeper discussion on what the rupee fall means, I mean, for the country's macroeconomic situation. Now, the first is that on the foreign exchange reserves, clearly from $700 billion, it's come down to 630 to $640 billion. And in the recent policy which RBI had, the new governor had, Mr. Malhotra had clearly said that even at $640 billion, the country has 10 months of import cover. The country's external debt ratios are pretty strong. Short-term external debt is close in the range of around 20%. The government has not really borrowed out. There is no the government does not issue G6 in the dollar market. Most of the liabilities on the FX side are all largely corporate through ECBs and credit lines and other deposits, NRI deposits, and many other factors, which is that. So in that sense, on the external debt ratios, even the rupee fall is not really driving down the macro situation of the country. So we are in no position. We are not in any kind of danger in that. The second is obviously on the inflation aspect of the rupee. Now we have seen that on a direct correlation basis, the cost of imports go up and the cost of oil imports go up, which is our largest import. And yes, I mean, the cost of oil prices can go up. Uh, but having said that, we have seen in the global markets, oil prices have been steady in a range of 70 to $80 per barrel, and after having come down from closer to $100 per barrel a couple of years back. So clearly, there is a lot of supply of oil in the market, and with economic, if it's true that global economic conditions can weaken, then demand for oil will come down, and oil prices can come down, and that can, to some extent, protect our import cover, and inflation can still be protected. In all this, so the direct impact on inflation, is, especially at the cost of consumer in terms of either petrol or diesel or kerosene or gas or all these, can have a slight impact, but not a major impact on the consumer wallet, which is a serious CPI inflation. So inflation effect is not so very apparent, except in the short term. And then you have the question of capital flows. Yes, capital flows is a sudden function of market sentiments globally, and the sudden issues, especially with tariffs and all coming in, had volatility, and foreign investors have taken money out of the country. But you have to see it in a context of one is that there have been very large inflows into equity markets where the returns have been extremely high, so profit booking is likely to be there, and also in the bond market, once the government bonds were introduced into the global bond indices, then there were inflow. Now the FIs are slowly, factoring in the impact of the depreciation on their investments in bonds, and maybe that could slow down. Or but if they see some stability at higher levels, then that may means that they could have more confidence to come into Indian bonds than other. So and start investing in bond markets. But maybe that will take about 2, 3 months of time, 4 months of time. Also, on the macroeconomic conditions, the RBI governor had forecast that they expect GDP growth at over 6% and inflation to be closer to 4% for the next full year. And all this put together, at least the RBI did cut rates by 25 basis points, but has still sounded a neutral policy, not a accommodative policy. And I think the RBI would be more closer to managing liquidity in the market, because the fact that they sold so much of dollars has taken liquidity out of the system, close to 3 lakh crores of deficit they have to manage. And they're doing by buying government bonds. They have announced OMOs for 60,000 crores, 20,000 crores already done. And likely that they will do more of such purchases. And for the bond market itself, if you take the government budget, which was released in the 1st of February, they have shown lower fiscal deficit. Borrowings have been slightly at or around the last year's level with a higher GDP base. absorption of government borrowing is not going to be an issue. And if rupee actually stabilizes at higher levels, you can expect more FI capital flows into government bonds at these levels. And that could add more strength to the government bond market, and bond yields could either stay stable or even fall from current levels. The 10-year has is around 6.7% levels and is likely to continue to stay in a range bound fashion till the demand and supply flows matches post April 25. Right. So, on the corporate bond side, clearly, there have been especially uh, slowdown in slowdown. I mean, lenders have faced an issue, and they have seen larger NPAs and some lot of delinquencies, especially in the personal loan and microfinance sectors, and there have been slowdown in lending across commercial vehicles, and other aspects. Slowdown in lending is okay, but the question is how much of delinquencies. But having said that, if you look at the RBI statement, governor statement in their speech last week, the governor had said that the bank's balance sheets and the NBFC sector is largely well capitalized. They do not see too much of pain for banks with slight rise in NPAs. So it's not even close to the scenario which was seen about 10, 12 years back when the banks were facing huge balance sheet crisis, and they were running at 8 to 10%, 11% kind of NPAs and capital adequacy. They needed to shore up capital, etc. That is no longer the case. The financial system is pretty strong at this point of time. So as long as investors are willing to look at each credit on its own merits, and the kind of liquidity support they can get, and how the management is handling this kind of situations, and take the call on what is the risk return profile of each credit, then they are much more comfortable. Nothing to really and so if they are holding clearly weak credits that can go weaker, then they need to find an exit route. And if they're having, if they can identify good credits with reasonably risk return profiles, then obviously it makes sense to have an investment if they're looking at investments and they're able to judge their investments, or their advisors advise them on their investments looking at these factors, then they could achieve better returns than what they're in their fixed income investments. So on the bottom line front, what am I saying on the rupee depreciation on bond markets? Uh, to some extent, yes, there is the sudden sharp fall in the rupee, which has been stable for a while, is suddenly opening eyes and causing a lot of talk. And this could continue if there is more FI outflows, equity markets fall, and bond yields start to harden and other things. But that'll start to stabilize in a couple of months. The macros are pretty much consistent. There is no great weakness in the macroeconomic situation of the country. The country is well able to handle any kind of rupee depreciation, and we have seen over the years. I mean, if you take the rupee has been a constantly depreciating currency, and with all the constant depreciation of the rupee, what we have only seen is that equity markets do rise, bond yields continue to move on local issues of demand and supply, and maybe local to inflation factors rather than any global issues. And they'll start to stabilize and at whatever level going forward, largely based on the kind how the economy behaves going forward, how the demand and supply stack up for government bonds and for other bonds as well, how the liquidity situation is managed and all that. So investors do have to watch out for the local factors. To some extent, yes, till end of March, the rupee can be on top of people's minds and make them risk averse, which is fair enough. I think investors can be risk averse at least, but then it should not prevent them from starting to look at good returns available in the risk return profiles available in bond markets going forward. Thank you very much for listening in, and do follow us on our podcast channels.